Wall Street lost to a cornfield in 2026, and nobody is talking about it. Dirt just beat the S&P 500 for the second year straight. While your 401k was doing the cha-cha with inflation, a beat-up patch of cover-cropped ground in Iowa pulled 13%. That is not a glitch. That is farmers quietly getting rich while the finance bros were panic selling. Let me show you how. 2026 kicked off, and regenerative farmland quietly smoked the S&P 500 again. Yeah, you heard that right. While Wall Street was busy panic selling tech stocks, every time the Fed sneezed, a bunch of cover-cropped, no-till, cow-rotating acres in Iowa and Georgia were printing 11 to 14% total returns last year. The S&P 500 did about 9.2% in 2025 and is wobbling around 6% annualized so far in 2026. That is not a typo. Dirt beat digits. Now, before the finance bros and Patagonia vests come for me, I know what you are thinking. Farmland is boring. Farmland is illiquid. Farmland is for your grandpa who still uses a flip phone. That is exactly why most people are sleeping on the biggest wealth transfer in soil happening right now across the United States. So today we are ripping into 5 secrets about investing in regenerative farmland that almost everybody gets dead wrong. And I promise you, by the end of this, you will never look at a soybean field the same way again. All right? Secret number 1. People think farmland returns are just crop prices. That is like saying your iPhone is just a screen. Here's the real deal. With conventional farmland, yeah, you live and die by corn and soy futures. But regenerative ground plays a totally different game. You have multiple revenue stacks. You get the crop yield, sure, but you also get soil carbon credits that companies like Microsoft and Shopify are buying hand over fist to hit their net zero promises. You get increased land appreciation because healthy soil holds water better, resists drought, and buyers will pay a premium for it in 2026. You get lease premiums from tenants who want regenerative acres because their input costs are lower and their yields are more stable. And in some states, you even get state-level tax incentives for practices that build organic matter. Wall Street calls this diversified cash flow. I call it getting paid 5 ways for doing one thing right. Most investors still model farmland like it is 1985. They see a line item for rent and a line item for appreciation, and they call it a day. That is why they miss. In 2025, regenerative operators in the Midwest averaged an extra 2.3% yield just from carbon and ecosystem service payments alone. That bonus alone beats most RET dividends. Secret number 2. Everyone thinks you need to buy 1,000 acres in Nebraska to play this game. Stop it. That is old money thinking. The United States farmland market in 2026 is getting fractionalized faster than a TikTok trend. You can buy into regenerative funds, land trusts, and private platforms for $100. You can co-invest with a rancher in Montana who is transitioning 200 acres to holistic grazing. You can back a first-generation farmer in North Carolina through stewardship deals where you own the land and they work. The point is the gatekeeping is dead. The suits used to own the whole game because they had the cash and the connections. Now the game is on your phone. And here's the kicker. Small parcels managed regeneratively often outperform the big conventional tracts. Why? Because attention to detail scales better on 80 acres than it does on 8,000. When a farmer can walk every inch of that ground, manage cover crop mixes, move cattle daily, and actually read the land, the soil organic matter climbs fast. And in land, organic matter is literally money in the bank. It is water storage. It is fertility. It is resilience. So no, you do not need to be Bill Gates to own farmland. You just need to be smarter than the average bear. Secret number 3. People assume regenerative means lower yields. That is the biggest lie Big Ag ever sold us. Year 1 of transition. Yeah, yields can dip. The soil is detoxing from years of synthetic inputs. It is like going to the gym for the first time in a decade. You are going to be sore, but by year 3 and 4, the data coming out of the United States in 2026 is wild. The Soil Health Institute tracked farms across 9 states and found that after 3 years of regenerative practices, corn yields were basically equal to county averages, but input costs were down 30 to 60%. That means profit per acre was up even when the yield was flat. And in drought years, which which we had plenty of in 2023 and 2024, regenerative fields blew conventional out of the water. Some regenerative corn in Kansas yielded 160 bushels during a drought while the neighbor's conventional field made 90. That is not ideology. That is math. So the S&P 500 can give you a great year when things are good. Regenerative land gives you a good year when things are bad. And in a climate that is throwing more curveballs than an MLB pitcher, I know which one helps me sleep at night. Secret number 4. People think farmland is not tech. Wrong again. Regenerative farmland in 2026 is running more data than a Tesla. We have satellite imagery tracking biomass daily. We have soil probes measuring carbon in real time. We have drones mapping water infiltration. We have blockchain for carbon credit verification. So a company in California can prove the credit they bought came from a real farm in Missouri. This is not your grandpa's overalls and pitchfork deal. This is biotech meets fintech meets climate tech. And the farmers leading the charge are young, data-obsessed, and profitable. Meanwhile, half the S&P 500 is still trying to figure out AI without nuking their margins. So when someone says farmland is not innovative, ask them when the last time Apple grew topsoil was. Secret number 5. Everyone thinks the only exit is to sell the land. That is lazy thinking. With regenerative ground, you are building an asset that gets more valuable the longer you hold it. Because soil health compounds, it is literally compound interest in biological form. 1% increase in organic matter can hold an extra 2,000 gallons of water per acre. That means less irrigation, less risk, more buyer demand. But beyond selling, you can cash flow it forever. You can do conservation easements and get paid to protect it. You can stack enterprises, lease the land for grazing, sell the carbon, run agritourism, host farm-to-table dinners, lease hunting rights. The S&P 500 pays you a dividend if you are lucky. Regenerative land can pay you from 6 different angles. And here is the part that makes the finance guys sweat. You cannot print more good farmland. They're not making it. The United States loses 2 acres of farm and ranch land every minute to development, but the demand for food, for carbon storage, for water filtration, for biodiversity, that is going up. Economics 101, limited supply, rising demand. You do the math. Now let me give you a relatable analogy, because I know not everyone here grew up baling hay. Think about your body. Conventional investing is like taking pre-workout, slamming energy drinks, and pulling all-nighters to get gains. Yeah, you might look ripped for a while, but your gut is wrecked, your sleep is trash, and eventually you crash. Regenerative investing is like eating whole food, sleeping 8 hours, lifting consistently, and drinking water. The gains come slower at first, but after a few years, you're strong, you're healthy, and you're not dependent on a bunch of chemicals to function. The S&P 500 is the energy drink. Regenerative farmland is the grass-fed steak and sleep. And I have skin in this game. I put my own money into a 42-acre regenerative transition in Tennessee last year. We planted multi-species covers, ran sheep, cut synthetic inputs to 0. Our tenant farmer is happier. The creek on the property is running clear for the first time in 20 years. And the land appraised 18% higher this spring. Was it liquid? No. Could I sell it tomorrow? Probably not. But I was not looking for tomorrow money. I was looking for decade money, legacy money, the kind of money that my kids will thank me for. Because here is the unhinged truth nobody on CNBC will say out loud. The United States financial system is built on extraction. We extract from soil, from people, from the future to juice returns today. And it works until it does not. Regenerative farmland flips that script. It is built on restoration. You make money by making the land better. Healthier soil grows more nutrient-dense food. It stores more carbon. It holds more water. It supports more families. And yeah, it pays you back. That is not charity. That is just good business. So where does that leave us in 2026? If you only care about beating the S&P 500 this quarter, go buy options and pray. If you care about building real wealth that does not evaporate, when the market has a mood swing, start learning about soil, because the next generation of rich in America might not be wearing suits in Manhattan. They might be wearing boots in Montana. And that brings me to the question that I know is going to start a fight in the comments. If you had $1,000 to invest today and you had to choose between the S&P 500 and a share of regenerative farmland, which one are you picking and why? Are you Team Ticker or Team Topsoil? Drop your take below. I will be reading every single one, and I'm not afraid to clap back. This is Organic Matters. We talk about food, land, and the money that moves it. If you got value from this, smash that subscribe button. We are just getting started. And remember, you cannot eat a stock certificate. See you next time.